All right, so thank you for your patience and let's begin today's session. So, what we discussed in the previous webinar, we basically spoke about how many stocks have, been sold off like crazy in the markets. We've seen Netflix down almost 70% from its highs, Nvidia, Airbnb, Tesla, Amazon, Adobe. These are some blue chip companies which are trading at almost 40-50% discount from the markets. So this is what we saw last week when we were in the webinar, and we also saw how majority of the indices. Okay, so one thing, people will try and make this session as interactive as possible. So when it comes to stock markets and the financial world, obviously it can get a little boring and drag. So as interactive as we make it, things will be much better and easier for all of us to understand. So when we saw last week, we saw Netflix, Nvidia, Amazon. We saw most of these stocks. In fact, many stocks on the Wall Street have been trading at a significant discount from their highs. Okay, and we also covered most of these indices which are trading at a significant discount from their 52-week high. So before I take this forward, can anybody tell me over here, when you see this S&P SPX 500, what does this 500 stand for? Come on, people, let's try and make this more interactive. I really need some answers from you all. What does 500 stand for in the SPX 500? For the ones who were there in the previous webinar, we've discussed this. And even if you were not a part of this, I'm sure most of you all would know what this means. So take up your chat boxes and you can respond. What does 500 stand for in the SPX 500? Come on, we'll try and make this much more interactive because otherwise it's not going to be fun either for you or for me. So the learning will be much more if we have someone out there who can tell what does 500, or for that matter, when you see Nasdaq 100, what does 100 mean when you see Nasdaq 100? Okay. All right, almost there. So, yes, now when you say SPX 500, 500, it's an index. SPX 500 is an index. So, 500 over here means the 500 companies that the S&P 500 is tracking. So it is it is tracking the 500 largest US companies by market cap, and it is the benchmark index in United States. So when you say today the US market was down by 4 to 5%, when we are saying that, we basically mean that the S&P was down by 4%. Or when you say the US markets rallied today, so most people are referring to the SPX 500 rallied. So on the other hand, when you see a Nasdaq 100, 100 means it's tracking 100 companies in the index. So the price is basically, instead of buying 100 companies individually, you can just buy Nasdaq 100 and participate in all of those 100 companies. So it is tracking the performance. And when I say the performance, it's the price performance, not how the company is performing. It's the stock performance. It's tracking the stock performance of those companies. So even all of these indices across the globe, you can see have been bleeding, and they have been trading at a significant discount. So last week when we were talking about markets, we discussed as to what were the reasons and the factors that contributed to such significant losses in the markets. So can any of y'all type and let me know what according to you is the reason responsible for the sell off that we've seen in the markets this year? There are multiple reasons out there, but if you can just name one or two, just like a simple thing. What fear is it that we are seeing in the market? Why are markets down? Is it I mean, there are multiple. I can give you multiple reasons why markets fell. We discussed this last week also. So even if you were not a part last week, but I'm sure most of you all are aware as to what contributed to the sell-off. Why have stocks fallen to this extent? All right, let's see if someone can come up with possible reasons behind the sell off. I am not going to move forward till the time I don't receive some response from you all, because we have to make this session nice and interactive, and that's how it will get interesting. Okay, we have Mr. Badr Abdul saying that maybe it was because of the war, which is amazing. We have Zainab Khan saying it was because of the Russia-Ukraine war. We have Jatin saying that it was because of inflation. Amazing. These have been the reasons. Okay, we also have interest rates. So yes, you all have nailed it. This has been the reasons which have contributed to the sell-off in the markets. So firstly, obviously, markets were already trading at extreme highs. So the valuation for most of the stocks were at high levels. Then we saw that, as you all said, there were a Russia-Ukraine crisis which aggravated the situation. Then obviously, inflation was already a big problem even before the Russia-Ukraine crisis. And when these crises happened, supply chain bottlenecks increased further. And now one of the biggest concerns for markets are inflation, because firstly, last time in the year 2020, 2021, there was so much money that was pumped into the system that there was a lot of money chasing few goods, and that is what led to inflation. Then now we had supply chain bottlenecks. Recently, China has also gone into lockdown and sticking to its zero COVID policy. So that has also contributed to further supply chain issues, and which has aggravated inflation. Now, to tackle inflation, what is the tool that central banks use? As you all rightly said, they have been focusing on increasing the interest rates. Now, when interest rates go up, obviously, it will be. So, how does an increase in interest rate help tackle inflation? Can someone say this? That why do central banks increase the interest rates, to tackle inflation? How does it work? Okay, so I mean, I think this could get a little lengthy to type. So let me give the answer to this. So the idea is that when the central banks increase the interest rates, obviously, of course, perfect. Zainab has said that this helps to curtail expenditure. So when interest rates are high, an investor will obviously be more interested and inclined towards saving than expense. So that is what contributes, to less demand for goods, and eventually that will bring down inflation. Mr. Abdul has also said because it helps control liquidity, and that is perfectly correct. It's amazing that you guys are participating and bang on with your answers. So that is the tool that central banks, use to control inflation. So, because interest rates go up, obviously for companies, it is a problem because their borrowing cost will increase. And because of that, there is a slowdown, or their profitability will come down, because of which stock prices have been falling, because this is actually leading to recession fears. If the profits will come down, if the demand for goods will also come down, because inflation is so high and people are not willing to spend that much. So that those fears are leading to recessionary fears as well. Anyone over here who can tell me what is the definition of recession? What does a recession mean by the actual technical definition according to economics and finance? What is recession? So everybody is like just fearing and worried about recession, but what is recession? I'm just waiting for some responses. Okay, Zainab says it's hyperinflation. That is one of the factors that could lead to recession. But the main reason, I mean, I'm asking what recession is. So hyperinflation could be the reason and the factors responsible for recession. But by definition, recession is nothing but two consecutive quarters of negative growth. So when your economy is not growing for 2 years, for two consecutive quarters, that is when we call that we have entered into recession. That's it, right? successive quarter of degrowth. Shom said this, so yes, that's bang on. So two consecutive quarters of negative GDP, that is what recession is. So the US has already recorded one quarter of negative GDP. So all it needs is just one more quarter, and by definition, we will be in recession. But the fears seem to be overdone. There is a lot of good news out there, and we discussed last week what were the good news that investors can cheer about, and hopefully the sell-off will not continue to the extent that it has in the past. So first and foremost, we spoke about how the inflation data in the US. So now this I'll be taking up quickly because we need to focus on how we need to invest in the markets in current volatile markets. So the good signs about the markets, we'll just be discussing the good factors right now, which can and which has made many analysts and businessmen out there optimistic. So, firstly, U.S. inflation has shown signs of easing. So, from in the month of April, it increased only 8.3%. Previously, it was 8.5%. So now, hopefully, there are signs that inflation has started to peak. The monthly rise in inflation was much smaller in the month of April. It was 0.3% compared to 1.2% in March. So, as and when the base effect, that means, so previously for 2020, 2021, the prices for almost all the goods had dropped drastically. Oil was nearly at 60, today it's above 100. Way before that, oil was at 20. So your base level, your base for oil was 60. And so when it goes up to 100, it's obviously almost double. But from 100, it needs to go to 200 for inflation to double, which is most likely not happening. So the base effect has gone up higher, and gradually inflation will now start coming under control. So that is one big positive for markets, because inflation is what is the biggest fear currently in the markets. Now, when we've all been worrying so much about inflation, but how can one fight inflation? So one of the easiest ways that will help you fight inflation in the long run, it is through the stock market. So just look at this data over here. Since January 1926 till the end of 2020, if you had $100, it had to grow up to $1,500 to meet the inflation expenses. Okay, so to meet inflation, you required your $100 to grow in value to $1,500. So something that could be bought for $100 in 1926, probably it required $1,500. The same product would require $1,500 in 2020. Now, if you look at this same comparison, if we were invested in the US stocks since 1926, that would have grown up to almost $45,000 at the end of 2020. So clearly, the stock market is helping you fight inflation amazingly. So, which is why we always need to be invested in the markets. All right. So, moving forward, what are the other positive signs? Of course, the labor market currently is still strong enough. The economy recently added 428,000 jobs. So, overall, the labor market is still doing well. The unemployment rates are near the lows. So, that is a sign, a positive sign. Moving forward, we also had recently the retail sales data last week, which came out good. We now, when it comes to the FOMC minutes, we saw that of course the central bank has the US central bank has increased the interest rates by 75 basis points. When I say 75 basis points, it means 0.75%. So they have increased the interest rates by 75 basis points, and they have said that we will be increasing the interest rates by another 50 basis points at each of the next two FOMC meetings. So that is what they have already said that they will be doing. And in fact, when you look at the CME Fed Watch tool, which basically is a tool that that is predicting that what will be the inflation at the end of the year. So markets have already priced in there is 100% probability that at the end of the year we will see interest rates at 2.5 or 2.75. So if you can see out here, the interest rate is expected to be at least a minimum of 2.5 to 2.75%. In fact, we have another 52% population who feel that interest rate would be 2.75% and above at the end of the year. So this is what markets are already predicting. So when we can say is that most of the negative news in terms of the rate shock, the inflation shock, all of this seems to be discounted in the market. The negative news seems to be already priced in the market. The reason for the fall, the 20% fall that we saw in the S&P 500, or the 50% fall that we've seen in stocks like Nvidia, or 40% fall in stocks like Amazon, that has been because of these fears. So most of the negative news seems to be discounted. Now, another positive factor is we were discussing about interest rates. Now, one way to see interest rates are through the 10-year treasury yields. Okay, it's the basically the yields that we receive on 10-year government bonds. Or when you want to look at the short-term interest rates, you can look at the 2-year treasury yields, because they will give you an idea of what is the interest you will receive on a 2-year treasury bond. So the 10-year treasury yields, obviously they've climbed significantly, like we can see from the lows to the highest. So at 3, when it went to as high as 3.2, since then the 10-year treasury yields have started dipping. Now, when they come down, obviously from for tech companies, this is a positive sign, because they are valued on the basis of the interest rates. This can get a little complicated, but in short, if I have to say, from a long term, for most of the technology stocks, whenever the long term yields come down, it is a positive sign for technology companies, because most of their valuations and their profits are based on what they will make in the future. So when you discount it back to today's date, that is how you value a tech company. So any fall in 10-year treasury yields is actually good for technology stocks and other stocks as well. So even for when we look at the 2-year yields, that is also near a resistance, and in fact it has already started coming down to a certain extent. So all of these signs are a little positive, and they're giving some hints that maybe the sell-off is overdone. Obviously, nobody can predict the exact dip in the markets, so these are just our judgments and analysis. But from the looks of it, most of the negative news in the market seems to be priced in. Now, when it comes to the S&P 500, can any of you all respond over here as to are you aware of what is a PE ratio? What do you mean by PE ratio? A simple response is yes or no, if you're aware or no. If not, then I'll explain. Okay, so we seem to be pretty divided over here. Some of them are aware and some are not. So let me tell you, a PE ratio is basically, it's called as price earnings ratio. So depending upon the earnings of a company, ha- at what multiple is the stock price trading? So it's the price divided by the earnings of a company, through which you get the PE ratio. So it's your the share price divided by the earnings per share, and that's how you get the PE ratio. So the higher the PE ratio for a company, actually it would mean that the stock is trading at a higher multiple. But you cannot just look at it in those terms. So how do you look at a PE ratio? A PE ratio you can compare in terms of maybe the long term average of a company, or you can compare it with the peers. So for example, when you have stocks from the same industry, and one company is trading at a PE of say 10, okay, so based on its earnings the share price is trading at a multiple of 10. So if the earnings per share of a company is say $10, which is too good, that would mean that the stock price, when the multiple is 10, that means the stock price is trading at $100. So how do you compare a PE? Now, for example, this company has a PE of 10 and another company has a PE of 20, and both of them belong to the same industry and they're selling the same product. In that case, you can say the company which is trading at a PE of 20, maybe it is overvalued and it is trading at a premium, and there's a good chance that it could come down. Obviously, you need to analyze if there's a reason why the company is trading at a high PE. If there's no such reason, then this gives you a market opportunity. Or you can also say that the company which is trading at a PE of 10 is undervalued, and maybe that stock will go up towards the PE of 20. So that is how we analyze and see at the PE ratios. Now, the reason why I was speaking about PE ratios is basically, so for the S&P 500 also, we can have a combined PE of all the 500 companies. Now, the reason why I was speaking about this PE ratio is based on the earnings. This year, companies have actually grown and they made a profit of 9.1% in the first quarter, so which is a positive sign. Now, of the companies that have reported, 77% of the companies came in with results that were above expectations. So they came with a positive EPS surprise, which is again a good thing. Now, based on the fall in the S&P 500 and the earnings estimate, the P ratio for the S&P 500 has come down to 16.4, which is much below their historical average, 5-year average, which was 18.6. And in fact, at the end of December last year, it was trading at almost 22. So the PE was 22 and now it is at 16.4, which is what you can see in the chart over here, that the price has come down now below the earnings estimate. So as you can see, as and when the earnings of the company grows, the stock price, the S&P 500 will also rise. And now the S&P 500 price is below the earnings. So going forward, hopefully, currently it is valued fairly, and hopefully we do not see massive losses like we have seen in the past. Again, this cannot be. There are multiple factors that are playing out in the market, but the current data that we can see over here, this is giving some positive hope for now. Now, yes, we also spoke about recession. So, how many of you out here believe that we will see a recession? A simple yes or no would help. That will we see a recession in the next 3 months? Yes or no? Or actually, 1 minute. Let me just put in a poll. I think that would be even better. So this, do we see a recession in the next, say, 6 months? Okay. So, All right, so it is almost pretty much divided. We have 50% who say that yes, we will see a recession, and we have another 50% who say that no, we'll not see a recession. Well, so currently, I mean, this is the data based on the last month, but according to one of the reliable measures that the U.S. Fed uses, the current probability of recession is merely 3.7%. So, which is obviously very low. Maybe this number has gone up this month, but currently the number is only 3.7% probability. And now it's important to look at this. Everybody has been talking about the recession and the kind of fear that we are seeing in the markets, that because of a recession, stock markets will fall, and so on and so forth. But just look at the kind of performance of SPX 500 in the last 20 years or so, more than 20 years, despite it having three recessions during this period. So since 2000 till 2022, May, SPX 500 has gained 173%. So we've seen three recessions during this period, but despite that, stocks have climbed up. So what we can say and conclude in this, looking at this, actually it looks like recessions are just mere bumps in the road. If you have a long term strategy and if you stick to your plan, eventually stocks have been giving significant returns out there. So this is all what we discussed in the previous session, and most importantly, what we said last time when we spoke about that. Eventually, these are markets, and trying to time the bottom is actually futile. So when we're looking at the stock market from the long term perspective, even if you enter or buy at the current levels, always stocks, when you look at them from a long term perspective, even if you end up paying a higher valuation currently, it will make you look much wiser because they're stocks at the end of the day. So in the long run, your decision will remain a wise decision, even if you end up paying slightly over right now. But that doesn't mean we go all in. We obviously need to have a strategy, and we need to decide how we need to play in the current markets and how we need to participate in the current markets. Now, before I conclude, and before we go forward towards our next session, it's these are just some quotes that I have stated as to what top CEOs and analysts from the industry, from the Wall Street, predict for the US markets in the coming months. Like what's next according to them. So we have over here, you have the UBS CEO who stated that we are not in a dot-com bubble like it was 20 years ago. We had some models, some companies which were just models, and they were just on paper. They were not giving any kind of returns. In fact, the last 20 years, tech companies have been able to show that there are real changes happening in the retail business, in the financial business, and that trend is not going to stop because of what we are seeing currently. So this is what the UBS CEO had to say. We had Credit Suisse chairman. He stated that investors should retain on a long-term perspective despite the temporary shakeout of the tech stocks, as companies within the tech sector will still remain solid and sound. Then, I'll just quickly go ahead. We had someone who had a Tom DeMark, who actually, called the bottom in COVID 2020. He said predicting a shock. He is predicting basically a shocking rally, which is headed our way as inflationary drivers, that is, energy and commodities, start to peak. So as and when inflation will come under control, he's predicting the markets to rally significantly. Then we have Peter, who's Garney, who's the head of Saxo Bank. He has said, obviously, we could have a lot of blood on the street. There will be casualties, but because of these casualties, there will be long-term winners, just like Microsoft, Amazon, Qualcomm, Intel, AMD. They took big losses during the dot-com burst, but if you look at their returns today, they have been significant. So they have been, great long-term winners. So, yes, this is what most of the people have been stating. We have the billionaire investor and founder of a private equity firm. He has stated that in 1990, 2000, 2001, when the internet companies had no revenues and in fact no earnings, they had nothing, just a business plan, and those companies back then shouldn't have even gone public. So, which is what led to the crash. But this year, this time, we don't have any such systemic issues. Companies have been reporting significant numbers. So he's basically given an example of even Netflix, which has 250 million subscribers. So it may not be as worth as what it was when the market was a few months ago, but it is certainly worth more in his view than what it is currently trading for. So as I showed you all in the first slide as well, Netflix is actually down almost 70% from its highs, from its 52-week high. Then we have another analyst, Mr. Blonde, who stated that, on bottom line, what he's saying is that most of the damage, the meaningful damage, has already been done. And being bearish today being more bearish today than you were 6 months ago is probably inappropriate, even if there is some more correction that is pending in the markets. So overall, as you can see, most of the people are saying that yes, there could be some more correction in the markets, but going bearish today, it doesn't make sense. We have Bank of America strategist who recently said that the tape shows the big damage is already done with the inflation shock and rate shocks largely priced in. So what he's saying is that once recession shock is also discounted, mostly you'll have the bottom set in and the lows will be set in. Now, again, you have many people over here. You have a Wells Fargo analyst saying that trying to time the market is obviously a foolish errand, and we shouldn't be doing that. So the way that one can participate in these markets is that you invest, form in a proper strategy and a proper plan, and gradually start entering into these markets. And this is what we will be discussing currently going forward. Just one last important stat and fact. So S&P 500 has experienced double-digit annual losses in only 13 years out of the last 94 years since 2021. And in fact, if you consider any 15-year period, rolling period since the year 1928, the stocks have never lost any ground. So in the long run, stocks have been giving decent returns. So when we're looking, a long-term investor can definitely feel much more confident when it comes to investing in stocks. So yes, now coming to the main part for which we've all logged in for today's webinar. Now, before I explain and before we understand this, how many of you understand what is leverage? Like, um, just again, a yes or a no. Do you know what is leverage? Only then you'll understand the concept when I say then avoid using excess leverage. Okay. So we have some people who are saying that we know partially what is leverage. All right, let me share a white screen with you and describe how what leverage is so that you can understand it better. All right, so all right. Now we have, suppose for example, you have $100,000 account. Now in the stock markets, if you have $100,000 account, ideally when you have $100,000 with you, uh, you can buy worth $100,000. But in the financial markets, you are allowed to purchase more than what you actually have. So if you want to buy Tesla and you have only $100,000, but you can also buy Tesla shares worth $200,000. So basically, even if you have $100,000, you can take trades double the amount. So what happens now when you take a trade worth $200,000? Suppose if Tesla goes up by 10%. 10% of $200,000 is basically $20,000. So you make a profit of plus $20,000, right? Now, we made a profit of $20,000, and our investment in this case, as you can see, was only $100,000. So, as a return on your investment, 20,000 divided by 100,000, we actually made gains of 20%. Okay, but Tesla went up only by 10%. So, because of leverage, this excess trade that you could take in $100,000, you could trade worth $200,000. So, this excess trade that you could trade was because of leverage. This is called leverage. So you are allowed to trade more than what is available as your investment in your account. So what happens is that Tesla went up only by 10%, but your profits went up by double 20% because you took two times leverage. 100,000 and you traded worth 200,000, so that is two times leverage. If you would have taken a trade worth 1 million, then that would mean you have taken 10 times leverage. Now, what happens? So, we saw a situation that Tesla went up by 10%, and wow, your profits doubled, and we made 20%. But what if Tesla were to go down by 10%? So, in that case, we would have made a loss of $20,000, right? So you have a loss of $20,000. Now, 20,000 divided by 100,000 is basically a loss of 20%. Your actual loss is just 10%, but because of leverage, your losses were also magnified. So in these markets, especially when the markets are so volatile, it is not recommended to take leverage because yes, leverage can magnify your returns, but it can also magnify your losses. So until and unless we see a clarity in the markets, it doesn't make sense to take leverage. So please avoid using excess leverage in these markets. So that is the number one tip. Now, secondly, how many of you are aware about SIP? When I say SIP, is I'm sure you must have heard this term. It's very common. So SIP is a systematic way of investments in the markets. So you either invest every month, you invest every quarter, you invest every 6 months or every week, depending on however you want to invest. But you form a plan and you stick to that plan. If you decide you will be investing $1,000 every month, then you stick to this plan and invest $1,000 every month. Now let's take a poll and let's understand if we would have done $1,000 SIP in the SPX 500 since the year 1988. That's more than 40 years almost. So what would have that grown to? Will it be $500,000? Will it be $1.5 million? Will it be $2 million? Or will it be like $3.2 million? So, because it's 40 years of investments, that would be close to your investment value would be close to $400,000. So that $400,000 would have grown to how much? 500,000, 1.5 million, 2.2 million, or 3.2 million? Well, we have some responses coming in. All right, we'll wait for another 5 seconds. Five, four, three, two, Okay, I'm still getting more responses. Come on, 5, 4, 3, 2, 1. All right. Okay, we have the votes are kind of divided. We have um, 25% who feel we'll make $1.5 million. We have 30% who feel we'll make $2.2 million, and we have 40% who feel we'll make $3.2 million. Well, the majority this time is correct. We will make almost $3.2 million. A systematic investment plan, hassle free, no tension. You need not think about where the markets will go in the next move. Will it go up? Will it go down? You just need to stick to your investments. Stick $2,000 every month, and today that is $2.5 million. Isn't that amazing? Yes, so in the last 10 years, in fact, if you were investing regularly in the SPX 500, your money would have doubled. In the last 20 years, your money would have grown almost 3 to 4 times. So that is the benefit of sticking to a regular SIP and a systematic plan. But currently, in the kind of markets that we are, maybe, I mean, of course, SIP will really work for you in if the markets remain at these levels. And if you already have an SIP on somewhere, I would really recommend that you stick with it. But there are many out there who believe as to how can we capitalize on this opportunity. Currently, there has been a fall in the market, so how do we capitalize on it? So one good way that we can capitalize on this method, on the fall in the markets, is through averaging. And that is basically a ladder form of investing that we call. It's our blue chip ladder portfolio. So give me a minute. I'll try and probably share my screen. All right, sorry. We'll stick to this as well. So, okay, is this pretty clear for you? Can I have some? Can are the numbers visible, or probably then if not, I'll share my screen and we'll probably I can zoom in over there if it's not visible over here. Can you see these numbers? 35%. Yeah.
You can change the studio.
Oh yeah. Okay. Okay, so I think it's pretty clear and visible now. So when we look at a ladder portfolio, what we are doing in this ladder portfolio is basically we will be dividing our investments in three phases. So as you can see, in the first phase, we'll have 25%. In the second phase, we'll have 35%. And in the third phase, we'll have 40%. These phases will be when the stock markets and the stock prices fall by, say, 10% and 20% in each phase. So in the first phase, we are expecting a 10% fall. In the second phase, we'll enter if there is a 20% fall for some stocks. For other stocks, we are expecting maybe a 15% fall. So that depends on which category the stock is. Now, as you can see over here, there are three categories. There's something called as aggressive, there's moderate, and there is conservative. Now, what is, when I say aggressive, moderate, conservative, what do we mean? Um, are you aware of the term beta? Have you heard of something called as beta? So when I say a stock has a beta of 1.5, can anyone tell me what it means? Okay, I believe not many are aware. So I'm getting responses that they don't know what is beta. So when we say a stock has a beta of say 1.5, what it means is that if the S&P 500 moves by 1%, this stock will move by 1.5%. So if the SPX goes up by 1%, this stock will go up by 1.5%. If SPX goes down by 1%, this stock will go down by 1.5%. So this is the meaning of beta. So we have divided this portfolio into aggressive. Aggressive stocks are the ones which have a beta of more than 1. So they move more than the market. So they are more volatile stocks. Then we have moderate stocks. Moderate stocks move in tandem with the S&P 500. And then we have conservative stocks. These are stocks which generally have a beta of less than 1. So if your market goes up by 5%, this stock will go up by less than 5%. Now, in the first phase, there will be some more allocation, that is like almost 30% is going towards conservative stocks. So, out of say, if you have a 1 million portfolio, $1 million portfolio, so 25% of that is 250,000. Out of that 250,000, 75,000 will go towards conservative companies. What are these companies? These are companies majorly which are defensive stocks. When I say defensive stocks, most of these are utility or health related stocks. These are stocks that tend to do well even if there's a recession in the economy, because the demand for these stocks is always there, irrespective of a recession. So you cannot say no to health related products. Even if there is a recession, you need the medicines, right? Same ways, if you need your day-to-day items, be it a recession, you need it, you need your grocery items. So these are stocks that tend to do well even if there is a recession in the economy, or if there's a slowdown in growth for that matter. So in the first phase, we'll be allocating more towards, slightly more towards the conservative stocks, because obviously there is a lot of fear out there in the markets. So which is why we will allocate some proportion to conservative stocks, but we will also allocate almost $87,500 to your moderate stocks. We have names like Microsoft, Apple, Bank of America, Royal Dutch Shell. These are all big names. It's a blue chip portfolio. These are all quality stocks with healthy balance sheets. And we'll have similarly $87,000 going towards the aggressive stocks like Amazon, Alphabet, Tesla. All of these stocks are down by almost 40% from their highs. Netflix is down by 70%. So these are some of the big names. We've also considered Marriott and Delta Airlines, which are a reopening play. As the economy opens up further and further, we see a lot of travel demand and pent up travel demand. So that will be positive for stocks like Marriott and Delta Airlines as well. Now, in the second phase, we'll increase our allocation. So when the stock markets have corrected, we will now go and invest in probably 35% of our investments. And that again will be divided accordingly between aggressive, moderate, and conservative. So when stocks come down, hopefully by then the recession and the slowdown fears will start gradually easing out, and that is the time we'll invest less, slightly less towards conservative stocks and more towards aggressive and moderate, because that will be an opportunity to capitalize in the markets when the stock markets fall. And then in the third phase, when markets correct further and there is a further correction, obviously, can anybody tell me which phase will have the maximum investment in the third phase when stock markets have fallen the most? It's available on the slide. Come on. Where will we invest the maximum uh, to capitalize on the opportunity when stocks have fallen the most? When you are expecting a rebound in the markets, for example, which sector, like aggressive, moderate, or conservative, which will be given the maximum weightage? I'm not moving forward till the time I receive some responses. We have to make this interactive, right? I have Mr. Mirza say it's aggressive. That's amazing. That's perfect. We have Zainab also say it is aggressive. Perfect. So aggressive stocks, hopefully when the markets correct, these are the ones which will take the maximum beating. And when you are expecting a rebound in the markets, so say when you are expecting the SPX 500 to jump by 5%, because these are aggressive stocks, they will go up much more. So they will go up by say 7% or 8%. So that is the logic. When stocks have fallen the most, and then we capitalize on that opportunity and invest in aggressive, the most, followed by moderate, and the least in conservative stocks. So this is how we plan to, invest in the markets. This can be a great way to participate in the markets, because I currently most people are fearing as to the whole idea and motive for this webinar for most of you all would be to find out, have the markets already bottomed, or is there a further sell off that is expected? Will it fall further? So nobody can exactly predict the bottom. And ideally, I mean, if you're trying to time the markets, many people have said that. We saw what even Bank of America chairman and Wells Fargo analyst had to say. It is impossible to time the markets. But what you need to understand is that stocks like Amazon, Microsoft, all of them have dropped like crazy from their highs. So we had many clients, who when Amazon was trading at its all-time high, everybody wanted to buy, and people were in fact crying that they missed out on the opportunity during 2020, and so on and so forth. That stocks have rallied significantly. But now, when Amazon has come down to those levels again and it is back, everybody's scared. Which is why Warren Buffett says that you need to be greedy when others are fearful, and fearful when others are greedy. So this is what we need to capitalize on. You cannot go all in, but it is time to start entering the markets slowly and gradually. Of course, whatever we say over here, it's very important that you consult and take an advice from your investment consultants, because for each person, their goal is different, their risk appetite, everything is different for every individual. So it's important you understand as to what is the best for you, depending upon your investment goals, upon your investment horizon. So whatever I say, it is very important. This is a generic statement. It's important that you consult with your investment managers before taking this decision. Right. So this is how overall your investment would look like. And this ladder portfolio is available on our website as well. We can have our RMs to share it with you all. If you've not received it, you can just ask your RMs; they shall forward it to you, and you can look at it in detail. Each stock has been given an explanation for each of these. In case if you are skeptical about individual stocks and do not want to invest in a particular company, so you can also refer to our index ladder portfolio. The idea and logic is exactly the same, but this would be divided between the United States and the European countries and UK, Canada, and Japan. So this is a well in such markets. It's very important that we diversify our assets. So I'm sure you all must have heard that don't put all your eggs in one basket. So this will help you diversify across the globe. Maximum investment will be given to United States, obviously, because it has the largest market cap. But when it comes to European indices, they have also witnessed a significant correction because of the Russia-Ukraine crisis. And eventually, if the crisis do fade out, and if we get through out of this, if inflation comes under control, it will be a good strategy to invest in these indices from a long-term perspective. Now, we have indices such as Switzerland, UK 100. Now these indices are more on the defensive side, and these are the indices which will help you trade in the current volatile markets and manage your portfolio well. So in case if you have another index which is fallen a lot, these indices will not fall as much because of their defensive nature, and they will help ride the volatility in the markets. So, for example, when SPX this year is down by almost 18% from its highs, UK 100 is down just 3%. Canada 60, which is a energy heavy index, is down just 9 to 10% from its high. That's because obviously it has a heavy weightage towards energy stocks, and energy prices, oil prices, we all know have gone up significantly. So that is, if you are not comfortable with a ladder portfolio, in stock ladder portfolio, you can look for an index ladder portfolio, or you can even go for a club of um, blue chip stocks portfolio where and an index ladder portfolio. So this is the diversification that I was talking about. We have US, we have Europe, UK, Canada, and Japan, and so on. Now, apart from stocks, one thing that ends up doing significantly well if there is any kind of slowdown or correction in the markets are generally it is bond markets. Now, this is not a short 100% rule. In fact, in the start of the year, both equity markets as well as bond markets were falling in tandem. But currently, as we see the 10-year yields start falling, there is a good probability that bond prices generally move inversely to the yields. I can explain this in a further in another session, the logic behind the same. But for now, you need to understand that when the yields fall, bond prices go up. So that is how they work. And currently, these bonds that we have shortlisted, these are municipal bonds, so they belong to the U.S. State government bonds. So obviously, there is definitely a lot of safety out there. They may not be as safe as the U.S. Treasury bonds, that is, the bonds issued by the government. But these are the respective bonds issued by the state government. So there is a lot of safety because of the fact that they are from the United States. So and most of these bonds are offering decent dividends. In fact, the net dividends after tax is close to almost 5%. So the number is pretty decent in such volatile markets. This is above, over and apart from what you could make on if there is price appreciation in the bond. So irrespective, even if the bond prices do not move, there would be a 5% that would be received as dividend on a yearly basis. So it will help you manage through such volatile markets. So basic allocation, say at least 20% of your portfolio can be allocated towards municipal bonds as well. All right. Now, we'll just take another 10 minutes or so. Now, coming to something called as market neutral strategies. Now, before I take this forward, it's important that I ask that how many of you know what is short sell? What do you mean by short sell? Quickly, a yes or a no. Yes, you know what is short sell, or no? Because it's important that you understand what is short sell for this um, for market neutral strategies. All right, we have few people say yes, they do. Amazing. Okay. So for the ones who are not aware, if I were to just quickly tell you, short sell is just the exact opposite of what you do in a normal trade when you buy a stock. So ideally, normally what we do is we buy first and then we sell. So when we buy something, for example, at $100, we're hoping for prices to go up. It goes up to $200, and then we sell. Maybe we've made a profits. But what if something is already at $200 and you are expecting it to come down? How can you profit from that situation? So in that situation, we can sell first, and then buy later. So this is something that can be possible in the financial markets. If I were to just give you an example as to how this works, say for example, we have iPhone has come up with this new iPhones, and you have in UAE recently, there has been a lockdown, and all the cargo flights and normal flights have been banned for almost a month. And we are in the month of September, and iPhone has come up with this new iPhones, and the demand for iPhone is crazy in UAE. So and you know of a friend who's recently come to UAE and has brought an iPhone along with him. And he's brought this iPhone for, gifting it to his wife. And his wife's birthday is, say, at the end of December. And we're currently in September, for example. So you see an opportunity over here. You ask your friend that, can I borrow your iPhone for a month, and I'll give it back to you in the same condition, a brand new piece. As it is, I will give you a brand new piece. I just need to borrow this for you for a month. Since he's a very good friend of yours, he says, okay. And so you borrow this iPhone from your friend, and you sell it um, uh, to whoever in the market really needed the iPhone. And this person was willing to pay, say, $7,000 for an iPhone. Okay. Um, so I'll just share the screen again. Yeah. So the person over here was willing to pay almost 7,000. In this case, it would be dirhams since we are in UAE. So, say someone is willing to pay 7,000 dirhams for your iPhone. So, you sold your iPhone first for 7,000 dirhams. You did not buy the iPhone, you just borrowed it from your friend, and you received $7,000 in your 7,000 dirhams in your account. Now, 1 month later, when the flights reopened, obviously there was a lot of stock available in the market. And what you did was simply go out there in the market and buy the iPhone for 5,000 dirhams. Okay, so you paid 5,000 dirhams and you received 7,000 dirhams. When you bought that iPhone back, you went and returned the iPhone back to your friend, and what you made out of this was $2,000, 2,000 dirhams in the process. So basically, you sold high and bought low. And this is also possible in the markets. You just need a broker, and through the broker, you can borrow a stock, sell it first, and then buy it later. So if you feel any company, just name any company that you feel it's not gonna do well in the coming future. So if you feel a company, the stock price is going to fall, you can sell it first, basically borrow the stock from your broker, sell it. Once it goes down, buy it again and pay the stock back to the broker. So this, I've explained it in very layman and simple language. It doesn't literally work like this, but this is how it works. If you even look at it on your demo accounts, if I were to show that as well, 1 second. So I'll just share my screen. So if I believe a stock is going to go down, and any stock, if you take, for example, say AMD, I don't believe this. And I feel this company is okay going to go down, and I want to sell it. I take a trade worth $1,000. I want to sell worth $1,000. So I've gone over here and I'm just going to place the sell order. This is my demo account, so I've just gone over here, entered $1,000, and I'm going to say place sell order. Yes. So I've sold something already, I did not own it, I've directly sold it. It is possible in the financial world. You can share something without owning it. Now, right, coming back to our presentation. So, what is market neutral? Now, a market neutral strategies are basically they try to capitalize on a situation on a situation in the market where they do not where you're not trying to see whatever is the movement of the stock market, irrespective as to where the market moves, the market goes higher or the market goes down. You are just looking at an opportunity between two instruments. This can either be commodities, stocks, but these instruments need to be correlated. So, for example, when I take the name Pepsi, what is the next company that comes to your mind? Come on, quickly, let's just wrap this up quickly. So, quickly, can I have some responses? When I take the name Pepsi, what is the next company that comes to your mind? It's amazing, right? How some people, all of us, can just think on the same lines. Everybody over here has mentioned Coca Cola, right? Exactly. So when you say Pepsi, the next company that comes to your mind is Coca Cola. So what we look for in these markets is we look for opportunities between two such companies which are highly correlated. They belong to the same industry. They're selling the same product. Now imagine if suddenly, if I were to just give you an example as to how a pair trade or a market neutral strategy works. So it basically involves buying one and selling one. Now, imagine, ignore the stock prices, ignore everything. Imagine if suddenly, so today both Pepsi and Coca Cola, imagine, are selling for $10, okay? And suddenly the price of Pepsi goes up to $15. What's going to happen next? Uh, I mean, everybody would start buying Coca Cola instead, because why would you end up paying $5 extra when both of them are more or less, providing the same product? Of course, the ones who are really fond of Pepsi and its taste will stick to it, but most of them will, for some time at least, switch to Coca Cola. What will happen then? Demand for Coca Cola will go up, whereas the demand for Pepsi will come down. Automatically, when the demand for Pepsi will come down, it will start lowering its prices. So from $15, Pepsi will come back down to, say, 12 to $13. And Coca-Cola, which was trading at $10 because of increased demand, it could now come back to 12 to $13. So both of them will again come back to parity. So market neutral strategies focus on this opportunity itself. Suppose due to some reason, um, Coca Cola shoots up, the stock of Coca Cola shoots up drastically, and the price of Pepsi doesn't shoot up to that extent. In that case, there is a market opportunity available over here, and we can capitalize on this opportunity by going short on Coca Cola stock and going long on Pepsi stock. So in this case, what you're doing is that you are not bothered about where the market is moving. All that is impacted and how you will be impacted are through these two companies. If they eventually start converging, if the prices start reducing between the two, we'll make money because we've taken the trade in such a manner that we are expecting the prices to contract. But if they increase further, if Coca Cola keeps going up further and Pepsi keeps falling for some reason, then it could lead to further losses. But what we've seen generally historically, unless there is some, massive reason out there, mostly you'll always get an opportunity wherein if stock prices have deviated significantly from their historical mean or their historical average, you can capitalize on this opportunity and take the trade. It's this kind of a trade is available not only for stocks. We can also look for such opportunities amongst commodities. One such example that I have in mind, you can see over here, is Brent WTI spread trade. So when we look at Brent and WTI, these are basically two qualities of oil. Okay, one is a light quality oil, one is a higher quality oil. Now, if you see in the past, if I'll just share my screen again, in the past, Brent and WTI have traded at a spread of almost, okay, just a second. I'm sorry. Okay, we look at it over here itself. Brent and WTI have traded at a spread of $5. So generally, Brent trades at a premium. So Brent prices will trade $5 higher than WTI. That is the historical average that we've seen in the last 2 years. As you can see in this chart over here, the average has been close to $5, as you can see. So that has been the average, $4 to $5. Okay, so Brent has traded at a premium of $5 over WTI. Now, suddenly, because of these Russia-Ukraine crisis, what happened was that this spread came down drastically, and Brent was now trading only at a premium of less than $1. So this gives you an opportunity. You buy Brent and sell WTI, and eventually, when Brent prices will start going up and WTI will start coming down, you will make money. So in this, what happens is that we are not bothered about where the markets are headed. We are just playing on the spread trade or a market neutral trade. It's a pair trade that we are playing on. Uh, is there zero risk? No, obviously not. There is great possibility that the spreads, if they are at zero point 0.6, they can fall further. But the chances of that happening are very low. Most factories have their refineries set up to the tune of Brent. So it is very difficult for factories overnight to, change their refineries and to ensure that they can now start working with WTI. So that balance, the spread will always maintain and will always be there on an average. So we've taken this trade multiple times for many of our clients. Whenever there's a dip in the prices, you take the trade, assuming it to go high, and when the prices go up significantly, you take a trade again, assuming the prices will come down. If I were to just show this on the screen, it just give me a minute. So here I can just, if we have to take this trade, yeah, actually I have it on, yeah. So if you can see, this is WTI, whereas this is Brent. Now for the day, now if you can see the difference between these two, Brent is trading at 110.7, whereas WTI is trading at 109.9. So it's slightly less than $1. Okay, so this is where you get an opportunity. We are expecting this 110, and we are not bothered either. This the price of oil can go up or the price of oil can come down. What we are expecting is that eventually this spread between Brent and WTI will actually widen. So if I were to go back and share my um, presentation, you can see what we are expecting if this spread widens. So whatever the prices are, if this widens to 3.5, we can easily make 14,000, $15,000 profit, which will be equivalent to 11% in less than 2 to 3 months. So that is what this is. 10% is an annualized return. So we can make 3% into 2 months, and if the spread actually goes up to 6%, 6 times, I mean, if the gap between Brent and WTI is $6, then actually we can make almost 5.5%. So we can do one-on-one sessions on market neutral strategies. If you need further clarifications, you can always reach out to us. Apart from that, we can also look at something called as Swiss row. There's a flyer for this as well. It has already been rolled out. This is basically we will be going long on Switzerland index and shorting the Euro 50 index. The idea behind this strategy is that Switzerland is basically it comprises a lot of defensive stocks. So if you can see, if I were to show it over here, you have healthcare, consumer staples, and okay, yeah, 39% belongs to healthcare, whereas uh, 23% belongs to consumer staples. So almost 60% is coming from defensive stocks, stocks that tend to do well even if the markets are volatile. Whereas over here, if you can see, a lot of weightage is given to stocks sectors such as IT. You have consumer discretionary, financials, industrials. These are sectors which can be susceptible to a slowdown. So if we go long on Switzerland and short Euro 50, there's a good chance that you can profit from the same and not be bothered about the market volatility. So all in all, these are some of the trades that we have covered, and this is the kind of portfolio allocation that you can look for. We can have 20% going towards blue chip stocks, the ladder portfolio that we saw, 20% towards the index ladder portfolio, 20% towards bonds, 20% towards the market neutral strategies that we discussed. These are strategies that are not available throughout. These are, and many, we even had gold spot futures trades that were available. So these are some of the trades that we can take whenever these opportunities exist in the market. You can reach out to me or your RMs for knowing more about these strategies, and then we can have some allocations towards defensive stocks. I've already explained what defensive stocks are. You can also look at some dividend yield stocks, and some money can be allocated and kept as cash, which can come in handy as and when there are more opportunities available in the market. So, yes, also of this ladder portfolio, also that we've discussed, you have to keep in mind that out of this 40%, only 10% will go in the markets upfront, the remaining will be invested in phases. So this is how you can participate in the markets in the current volatile times. But like I said, this portfolio is not a generic portfolio. You need to get in touch with your RMs, with your consultants, with your risk managers, and decide what is appropriate for you. So this is it from our end. If you have any questions, please feel free to ask. I'm sorry the session got extended a bit today, but it was really nice because all of you all were participating and active during the session. So in case if you have any further doubts, please feel free to ask. If not, we'll wrap the session for today. All right, so I think it's an end and a wrap for today. Thank you very much. We thank you once again for joining in, and hopefully, we'll see you at our next webinar as well. Thank you once again.